On Monday morning, October 19, 1987, the world woke up thinking it was just another ordinary day. But within a few hours, global stock markets collapsed with a speed and magnitude never seen before in modern history. Phones rang nonstop in Wall Street trading floors. Brokers screamed over each other, computers froze, orders stacked up, and stock prices began falling not in percentages, but in freefall. By noon, one thing became terrifyingly clear. No one was in control. Not the traders. Not the banks. Not even the government. The Dow Jones wasn't simply dropping, it was crashing, plummeting by 508 points, a devastating 22.6% loss in a single day. To understand how catastrophic this was, the equivalent drop today would be over 7,000 points in one day. Investors called it the day the market died. Economists called it a financial heart attack. And history remembers it as Black Monday, the largest one-day stock market crash ever recorded. But what really caused it? A recession? A war? A political crisis? None of the above. The truth is far more shocking, and far more relevant to today's markets than you might think. Section 1: The Calm Before the Storm. The early 1980s had been a period of optimism in the United States. Inflation had fallen dramatically, interest rates were stabilizing, and new technologies, including the first generation of computer-based trading systems, promised a faster, more efficient market. Between 1982 and 1987, the Dow Jones Industrial Average surged over 250%. Wall Street was euphoric. Ordinary families, young professionals, and institutional investors all believed they were witnessing the beginning of a new golden age. But beneath the surface, the foundations were far weaker than they appeared. The market was overvalued. Corporate debt had exploded. And a new computerized trading technique, soon to become infamous, was quietly spreading through the financial world. This technique was called portfolio insurance. Section 2: The Seeds of Disaster, Portfolio Insurance. Portfolio insurance was promoted as a revolutionary safety system for big investors. In simple terms, it used computers to automatically sell stocks when prices began falling, supposedly to limit losses. It sounded logical. It sounded safe. Investors poured billions into it. But there was one catastrophic flaw. If every computer automatically sells during a downturn, everyone ends up selling at the same time. By 1987, major institutions were using portfolio insurance. And without realizing it, they had created the perfect setup for a chain reaction meltdown. Section 3: Pressure builds around the world. In the months leading up to October 1987, cracks began to show. Rising interest rates raised fears of slowing growth. The U.S. trade deficit reached record levels. The dollar started weakening against global currencies. Global markets from Tokyo to London began to fluctuate. Still, most investors weren't worried. Markets sometimes fell, but they also rose. And after years of huge gains, the idea of a true collapse felt almost impossible. But the global financial system was now highly interconnected. If one market stumbled, the others would feel the impact almost instantly. Section 4: The Weekend Before the Crash. On Friday, October 16, the Dow dropped 108 points, a 4.6% decline, one of the largest at the time. Still, traders believed Monday would bring a rebound. But over the weekend, panic spread overseas. Hong Kong's market tumbled. Australia's market plunged. London followed. One financial historian later said, "The fire was already burning overseas. Wall Street just hadn't smelled the smoke yet." Section 5: Black Monday begins. When the New York Stock Exchange opened on October 19, sell orders flooded in instantly. Traders couldn't keep up. Computers fell behind. Market makers stopped answering phones. The more prices fell, the more portfolio insurance programs triggered automated selling. The more automated selling happened, the faster prices collapsed. It was a downward spiral with no brakes. By late morning, the Dow had fallen over 200 points. Then 300. Then 400. By the end of the day, the index collapsed 508 points, a staggering 22.6% in a single session. To put this into perspective, the 1929 crash, which caused the Great Depression, saw a 12.8% drop on its worst day. Black Monday nearly doubled that. Section 6: Panic across the globe. The United States wasn't alone. Around the world, markets collapsed. Hong Kong, minus 45%. Australia, minus 41%. UK, FTSE 100 minus 26%. Canada, minus 22%. In many countries, trading was halted. Banks feared insolvency. Rumors spread of the entire global financial system collapsing within hours. A Wall Street trader later said, "It felt like watching a plane crash in slow motion. You knew there was nothing you could do." Section 7: The Heroic Intervention. Amid the chaos, one man made a decision that would change financial history. Federal Reserve Chairman Alan Greenspan. On Tuesday morning, he issued a short but powerful statement. The Federal Reserve stands ready to serve as a source of liquidity to support the economic and financial system. Those words restored confidence. The Fed began injecting money into the banking system. Markets slowly stabilized. A full collapse was avoided. Without that intervention, many economists believe the world might have entered a depression. Section 8: Why Black Monday Still Matters Today. Black Monday was not caused by a recession. Not by a war. Not by political instability. It was caused by something far more dangerous. A fragile system, combined with blind trust in automated trading tools. And if that sounds familiar, it should. Because today's financial markets are far more automated than they were in 1987. High-frequency trading. Algorithmic systems. AI-based strategies executing millions of trades per second. Economists warn that a similar chain reaction could happen again, only faster. As one financial analyst put it, Black Monday wasn't a one-time disaster. It was a warning. A warning about overconfidence. A warning about automation. A warning about how fragile the global economy truly is. Section 9: The Aftermath. Surprisingly, the economy itself remained strong. There was no recession. No long-term depression. The market recovered within 2 years. But Wall Street was changed forever. Regulators introduced circuit breakers, automatic trading halts during extreme drops. Stricter oversight of computerized trading. New coordination between global markets. The crash also exposed a truth that still shapes markets today. Fear spreads faster than logic. And panic can destroy billions in minutes. Conclusion: Black Monday remains the largest one-day stock market crash in history, a moment when the world realized that technology, optimism, and growth could not protect markets from chaos. It is a reminder that even in times of great prosperity, the system can break instantly, violently, and without warning. And perhaps the most important lesson is this: markets don't crash because numbers fall. They crash because humans panic. And panic is timeless.